Hi everyone, just a quick update to the main video. Now this was recorded on the morning of Sunday the 12th New Zealand time, and on Monday morning New Zealand time the Federal Reserve announced that it would make additional funding available through a new banking term funding program to provide additional liquidity to banks that are facing withdrawal requests. So that means that banks are not going to be forced to sell long-dated securities in times of stress. The Fed's also provided an additional $25 billion of backstop funding on top of this as well. So this means that the FDIC will be able to release all funds held by Silicon Valley banks on Monday, whether they're insured or not. So all SVB customers will receive their deposited funds on Monday morning US time. Hi everyone, for any stock watchers out there, Thursday and Friday last week will have proved pretty exciting, and not necessarily in a good way, with the major US indices posting the biggest weekly losses of the year to date. The S&P 500 dropped 2% on Thursday the 9th and a further 1.5% on Friday the 10th, for a weekly decline of around 5%. The headline numbers were significant, but as is often the case, the devil's in the detail, and in this case, the devil lies in the financial services sector. The financial sector of the S&P 500 was down around 8.5% for the week, driven by investor fear as not one but two banks in the US failed. Now we're going to take a look today at what's happened here, what some of the root causes were, and what might happen in the next few days as a result, and where to from here. Now, I'm going to say up front that I'm no expert in banking, so this isn't going to be a deep dive into the details of bank balance sheets or banking regulation. But the root cause here actually appears to be relatively straightforward, and it really comes down to risk management practices within each bank. So the two banks in question both have customers highly concentrated in specific sectors, both relatively risky sectors, and both banks have made what appears to be relatively ill-formed decisions around asset purchases. So it might be easy to assume that these two banks failed largely due to the risky nature of their businesses and the customers that they chose to serve, but I don't think that's really the whole story. In both cases, the root causes here looks more like traditional bank risk management failure, specifically what's known as maturity mismatch. But I do think that the context of the segments of focus for those two banks is important, as it does help explain the circumstances that led to their collapse. Silvergate, based in San Diego, is a small bank which reached a peak of around $12 billion in deposits in 2021, and it focuses primarily on taking deposits from crypto entities such as crypto exchanges and wallet providers. Silicon Valley Bank, or SVB, is much larger, with over $200 billion in deposits, but it's still a niche bank in that it focuses squarely on providing banking services for early-stage venture capital-backed startups, mainly in the tech sector. And it's worth mentioning, while it's large compared to New Zealand banks, so ANZ, for example, has less than half the deposits than SVB, and while it's the 16th largest bank in the US, it's actually relatively small compared to the major US banks. So it's less than a tenth the size of JP Morgan, for example. Over the last several years, both banks have seen their cash deposits grow significantly. Silvergate is the crypto bank of choice, managed deposits for some of the largest exchanges in the world, including the now defunct FTX. And as the crypto bubble's blown ever larger over the last few years, those deposits have swelled. In the case of SVB, tech valuations have skyrocketed over the same period as well, and startups have been raising larger and larger sums of cash, and cash that wasn't expected to be used straight away and needed to be banked somewhere. And as bank deposits rise, the problem for banks becomes what to do with the cash that piles up. Typically, banks will take cash deposits and reinvest in assets, such as loans. They'll lend out funds to customers at a higher rate of interest than they pay depositors. SVB did do this, so lent more, grew its loan book. Its loan book grew as high as $66 billion at one point, but there really were limits to how far they could take this given the type of customers they served. Startups, by their nature, are young, unproven, unprofitable, and generally cash flow negative, so they often can't borrow money. So as SVB ran out of customers to lend to, it loaded up in capital markets instead, buying a range of securities, including long-dated US treasuries. Now, to be clear, this is not unusual or normally an issue. So banks will usually hold some allocation to treasury securities on their balance sheet, usually with terms matched quite closely to the deposit book. So if they have a high level of deposits on call or on short terms, they'll tend to invest in shorter term securities. But the trigger for the bank's collapse here has come in two stages. First off, from early 2022, as I'm sure we're all aware, inflation started to become a major global issue, and central banks have started on a campaign of sharp increases of interest rates as a result. Now, when interest rates rise, the value of longer dated bonds tends to fall. SVB's portfolio of long dated bonds are reported to have been paying an average yield of 1.7% per annum. So what that means is for every $100 they invested in bonds, they were receiving $1.70 per year in interest payments. So this portfolio of assets of bonds was largely all purchased prior to 2022, when the Fed cash rate was down at 25 basis points. Now the Fed cash rate has increased since then to 4.75%. So the 2-year yield on treasuries is now sitting at around 5.7%, and the 10-year yield is around 4%. So that means for every $100 invested in 2-year bonds that you purchase today, you paid $5.70 per year instead of that $1.70. So if an investor in market can spend $100 to buy a 2-year bond today and earn 5.7% on it, then they're not going to be paying SVB $100 for its bonds that are only paying 1.7%. If SVB wants to sell its bonds, it's going to have to sell at a discount or at a loss. And that's essentially what's happened to SVC's assets. They're suddenly worth a lot less than they were a year ago. Now, this isn't necessarily a problem. If these securities are held to maturity, as they often are, then they pay out at face value. So if the bank bought $1 million in 10-year bonds in late 2021, then they just have to wait until late 2031 and they'd get their money back. But the rise in inflation and interest rates has been affecting valuation of other assets as well. So Bitcoin, for example, peaked in value at $67,000 in late 21 and dropped as low as $16,000 in late 22. And in the case of venture capital, companies have been subject to lower valuations and more difficulty raising money over the last year or so. In both cases, this has led to depositors calling on cash held with both banks. Silvergate's deposits dropped from $12 billion to less than $4 billion, for example. And as those deposit levels have come down, both banks have been forced to start selling down their bond portfolios at significant losses. So this came to a head for SVB on Thursday as it announced that it had been forced to sell $21 billion of its securities to meet these withdrawal requests. And it launched a capital raise, which sparked significant concern regarding its solvency, and in turn a stampede of customers starting to move cash out of the bank. This is exacerbated by VC firms talking to the portfolio companies in some cases and advising them to withdraw funds. On Thursday the 9th, customers tried to withdraw over $42 billion in deposits in the one day. So it's nearly a quarter of the bank's total deposits. And ultimately, Californian banking regulators were forced to step in, and they've appointed the Federal Deposit Insurance Corporation, or the FDIC, as a receiver to the bank. Now, in the US, the FDIC insures deposits in the event of bank failures, but it's only to a limit of $250,000. So in SVB's case, because so many of their customers are VC firms and portfolio companies that have raised big sums of cash, there's reports that as many as 97% of the value of the deposits on hold are over $250,000 and therefore uninsured. So the implications here are twofold. Firstly, the impacted customers who are no longer able to access their funds, and the potential flow-on effect for their businesses and customers. So this could be significant. Some estimates out there are that as many as 50% of VC-backed startups in the US bank in some way with SVB. Reports this weekend are that companies such as the streaming provider Roku apparently held around $500 million of cash with SVB, around 25% of their cash. The New Zealand-founded Rocket Lab reportedly had close to $40 million, or 8% of their cash with SVB. New Zealand's Comvita-backed startup Caravan Honey held around $2.5 million of cash with the bank. So for these bigger guys, they can probably manage through this, right, for the short term, at least until there's more clarity on the situation. Rocket Lab, for example, seems to have been relatively prudent managing its banking risk. So while 8% or $38 million of the cash is a big deal, it's not life-threatening for them. The situation might be quite different for smaller startups or for those who relied solely on the one bank. And there's concerns of tech companies being able to make payroll next week, for example. The FDIC has indicated that there's an advanced dividend due to be paid to depositors this week. And so far there's hope that depositors will largely be made whole. Although the high levels of uncertainty and timeframes around releasing funds is creating some significant concern. The second broader and perhaps more significant concern is how widely prevalent the same issue is for other banks. That is, are there other banks out there whose assets have fallen away in value to the point that if they had a rush of withdrawals as well, would they find themselves in the same position? So from a local New Zealand perspective, it looks initially as though the first issue the impact of SVB directly won't be that significant for local startups and tech firms. So SVB had limited presence here. Those that were exposed seem to have been managing their risk fairly prudently. There might be some second order effects. So there's a number of payment processors, Rippling, for example, who banked with SVB. ChargeBee has been notifying customers to stop making payments to SVB accounts. But hopefully this will prove to be a more sort of solvable operational issue rather than anything more systematic. In Australia, there's indications of some wider impacts. So Canva, for example, was reported to have sizable sums with SVB, and companies like Crimson Education and PlotLogic over there appear to be affected as well. The risk of contagion to other banks is more of an unknown at this stage, although to be clear, observers are largely viewing this as an isolated event so far. This, as I said before, this appears to be a traditional banking risk management failure at a bank level, compounded by riskier sort of single sector focus. And there's no real evidence right now of a more widespread issue. Goldman Sachs, for example, have already said that they view the risk of contagion from the smaller to larger banks as pretty remote, given that regional banks have such a low share of institutional grade credit. And they view the risk of a capital or liquidity event amongst big banks as pretty remote as well. It is possible that there's other pockets of hidden risk out there, for example, with smaller regional US banks. So the KBW ETF that tracks regional US bank share prices is down 15% last week as a result. But large main banks such as JP Morgan, etc., don't so far look to be a significant risk. The banking regulator has been quick and decisive in responding to contain risk, and so far it looks likely that SVB assets and deposits will be taken over by a larger bank who'll be able to fund those deposits quickly. In fact, there's a strong chance, based on initial views, that depositors will recover their funds in full and that SVB will be acquired, most likely by a larger US bank attracted by their client base. And the value of the SV brand is the banker to tech. Here in New Zealand, there's certainly no indication at this stage of similar systematic risk. For example, no main New Zealand banks have crypto exposure. I'm not aware of any main banks that even do business with crypto firms. Capital reserves are high, asset quality is generally pretty high, there's no indication of panic on the street. Bank assets in New Zealand are heavily weighted towards property secured lending, and while property prices have obviously fallen this year, efforts by banking regulators to increase capital requirements since the GFC have meant that banks here are in a much, much stronger position to weather downturns like this. There's no indication of panic amongst depositors here that would trigger the same sort of bank run that we've just seen in the States. It's true that New Zealand bank deposits are not insured. So just to be clear, we're one of the only countries in the developed world that doesn't have a bank deposit insurance scheme. There is a deposit takers bill currently in draft which would implement an insurance scheme for deposits of up to 100,000. That's expected to come to effect in the next year or two, assuming it survives the next election. Overall, it looks so far that this is likely to affect a relatively small sector of the banking system. Most clients affected will manage through, and the issue is limited to a small number of higher risk institutes with less than ideal risk management processes and frameworks. So that's us for now. Thanks for watching. See you next time.